One of the first deep dive films I made on this channel was a look into the risks of private market funds. Over recent decades, private equity, private credit, and private real estate have attracted staggering wealth with their promises of outsized returns. Yet something always didn't feel quite right. The returns were too good, their data and methodology too opaque, and there was always a persistent incentive problem. Nonetheless, this mountain of wealth just kept growing. Concerns were ignored. Yet now, some real cracks may be beginning to form. There are trillions of dollars in private credit. The basic model of private credit funds is to raise money from investors and to borrow from banks. Making use of their superior borrowing terms, they can turn around and lend to riskier borrowers at higher interest rates, generating large levered returns that are returned to the happy investors. This sector of the economy has become known as shadow banking, for these funds and firms have taken on the role of major lenders, yet all the while operating in the shadows, far more opaque than their banking counterparts. And this has placed enormous systemic sensitivity on the part of these obfuscated lenders. Beginning in September last year, subprime auto lender Tricolor Holdings would file for Chapter 7 liquidation. This firm had been making loans to borrowers with low credit scores, or in some cases, no credit history. Some of these borrowers appearing to be migrants illegally in the country. Yet as their loan portfolio began to erode, allegations of systematic fraud would emerge, alleging that Tricolor had engaged in double pledging collateral, manipulating loan files, and misrepresenting performance data. This collapse would send shockwaves around the financial sector, with some very large banks, including JP Morgan, exposed. Concerns over private loan portfolios were beginning to rise. Fifth Third Bank would disclose an alleged external fraud tied to a $200 million loan. Later in the month, problems like this would continue. Auto parts supplier First Brands Group would file for Chapter 11 bankruptcy. Creditors would allege massive fraud, stating that up to $2.3 billion had simply vanished. There would be allegations of off-balance sheet financing, the double pledging of assets, and engaging in duplicate VIN schemes. As a result, the Department of Justice would open an investigation. Creditors, including CLO holders and private credit investors, would face billions in potential losses. Today, private lenders are an enormous part of the economy. While they are not able to engage in money creation in the way that banks can, they act as enormous points of leverage within the global economy. One may look at private credit firms and their investors and assume that if their portfolios were to go bad, that the losses would be limited to them. Yet often these investors are enormous institutional portfolios, investors like healthcare funds and pension plans, funds where catastrophic loss would have effects on many people beyond those directly involved. Yet more than that, banks lend to private credit funds. If a private credit investor were unable to pay back those loans, then quite quickly, the poor lending decisions of private credit funds would be translated to losses for the banks. The risk present in private credit would affect all of the economy, and so as more instances of bad lending began to emerge, market participants across markets began to become more and more concerned. In October, JP Morgan CEO Jamie Dimon would voice concern about this during the company's earnings call. He would state, quote, "When you see one cockroach, there are probably more." Jamie Dimon has a rather unique role in the financial system. His voice carries far more weight than most anyone else. And so, as investors and financiers heard Jamie Dimon make this warning, concern relating to private credit became much more severe. Many would begin increasing scrutiny. Lenders would look more carefully at their underwriting standards, reconsider their use of leverage, and begin to think carefully about hidden exposures. One hidden exposure risk that was particularly prevalent and became a point of widespread concern was the risk of artificial intelligence affecting software investments. Up to this point, there had been an enormous amount of lending to software companies. The software as a service sector was enormous, yet as AI models came out, particularly OpenClaw, Many began to wonder what this would mean for the software sector. Why would a firm pay an enormous amount for software if there was a model that could simply make a bespoke version of it at a much lower cost? Suddenly, the future cash flows of software firms came into question, and perhaps, if the effect were substantial enough, that could mean that they may not be able to pay back their loans. In November, Double Line Capital's Jeffrey Gundlach would accuse private lenders of making garbage loans. He would further go on to predict that the next financial crisis would begin in private credit. Later released Fitch data would show that US privately monitored rating defaults would hit a rate of 9.2% for 2025, up from 8.1% the previous year, a number much higher than that for broadly syndicated loans. There was a worry growing, and many prominent voices were beginning to sound an alarm. So much money had poured into private credit over the past few years. Was it possible that in a race to deploy capital, they had made some bad loans? And if you've listened to any of my financial series thus far, yeah. Though cracks were beginning to emerge, serious concern would hit when a flagship retail fund of private credit firm Blue Owl would halt quarterly redemptions. Investors were becoming concerned and they wanted their money back. However, as the investments of funds like this are illiquid, with the portfolio mostly in its loans, there's only a limited amount of cash available to pay out investors who want to exit. Thus, if any real mass of investors wanted to leave, the fund would have to sell off its assets. One very big problem emerges when this happens. These loans aren't very easy to sell, particularly not at values that the fund had been telling investors. Quarterly, private credit funds are able to value their own portfolios, presenting a net asset value to their limited partner investors. However, if they ever actually needed to get cash for those loans, they would have to sell it off to somebody else. And when that happens, very rarely are they able to get $1 on the dollar. It's common to see secondary sales like this be down at 90, 80, 70, or even 60 cents or lower on the dollar. So those returns that investors believed that they had suddenly vanish. Those valuations were just on paper, and they didn't have assets that could actually become that cash. And so facing a risk like this, often the solution for private market fund general partners is to simply limit how much money investors can take out, refusing to pay out more than a certain amount in a given quarter. Not long after, a Blackstone flagship fund would see record redemption requests, hitting about 7.9%. This was beginning to cascade to more funds. More firms, including Morgan Stanley, would begin placing limits and caps on redemptions. Now the market was in a situation where investors were becoming nervous, and more wanted to pull their money out than the funds were allowing. The AI disruption risk was a major component. The concern that software loans would go bad was very prominent. UBS would warn that defaults could reach 13 to 15% in a scenario of severe disruption. The potential ripple effects were becoming visible. If more investors wanted to pull out fearing bad loans, then private credit funds would have to sell off their assets in order to make those redemptions. That, in turn, would push down the values of these loans. And as the private credit funds themselves were coming under pressure, banks began limiting how much they would loan to these funds. For remember back to the fundamental model. Private credits borrow from banks on very good terms, and they turn around to make loans to riskier borrowers. Well, what happens when the private credit funds aren't able to get those loans from the banks? Suddenly, the credit supply as a whole contracts. There was a multi-front problem. There was a counterparty risk problem. There was a credit supply problem. And on a deep level, there was a collateral problem. Going into 2026, the financial sector was staring down a potentially very disastrous cascade. Something like this could quite easily spiral. Credit assets go bad, lending dries up, and quite quickly funds and firms fail, and the economy grinds to a halt. Throughout February and March, concerns would only grow. Jamie Dimon would reiterate his concerns, this time drawing parallels to the lead-up of the 2008 global financial crisis. Yet at the same time, many financial institutions were attempting to calm investors. Bank of America would forecast that private credit defaults would ease to around 4.5% in 2026. Financial firms would acknowledge the problem, yet the general message would be that it's all contained, everything will be fine. Yet one should consider that that's always what the financial sector says. They absolutely cannot tell people that everything is collapsing, everything is going to be catastrophic, and yet perhaps even they can't even acknowledge that things might be a little bit of a problem. For ultimately the entirety of the credit system, finance as a whole is based on confidence. In fact, money itself. The entire global economy is based on people believing in it. So by necessity, banks are going to have to say, it's okay. But it was clear that the market didn't fully believe this. Investors still wanted to pull their money out, and they were still being restricted. Over recent weeks, more and more firms have become affected by this. JP Morgan, Barclays, Fifth Third, Market Financial Solutions, Morgan Stanley, BlackRock, Deutsche Bank, Blue Owl, Blackstone, Ares, Golub, Cliffwater. There are some enormous lenders that are exposed, and right now the situation we appear to be in is that investors are becoming concerned, and many want to pull their money out of such credit funds. Yet knowing the cascade that would lead to, the funds are placing very strict limitations on how much money can actually be taken out. This causes further worry, and now the question remains just how severe this will get. At present, I can't declaratively put forward a statement that this is going to lead to catastrophic systemic damage. It is still early and there are different routes that this could take. On the one hand, there could be a bad loan cascade. The result would be defaults, serious write-downs in portfolios, substantial realized losses, a sharp contraction in the credit supply, and ultimately, a severe slowdown in the global economy. Yet alternately, things could get better. It could turn out that these software companies are actually going to do okay, that they will be able to pay back their loans. The loans could remain sound, and as investors realize this, the private credit portfolios would be able to be marked back up to a nice, healthy return to the investors. Lending continues as normal, the banks breathe a sigh of relief, and the economy keeps chugging along. The main problem with this very happy scenario is that nobody knows what is actually going to happen in the software sector. And note, the entirety of bad loans aren't just limited to software. Even if things do ultimately turn out to be okay, that won't determine investor behavior in the present. There can be severe financial crises simply because investors are afraid. We could see the credit supply dry up because investors are afraid of what will happen in the future, regardless of what actually happens. So it's difficult to believe that everyone will get out of this entirely unscathed. Yet the severity of what will happen remains to be seen. I don't mean to put forward a catastrophic dire warning. This channel has never been inclined toward everything is collapsing and the end is near. In fact, most films here have been relatively optimistic, seeing that there are some really great things that could happen in our future. Noting that in the sea of fear there are some very positive signs. Yet I've also never veered away from the risks. And right now, this one looks different. This one does look like something very serious to keep an eye on. This will be worth tracking as it goes forward, and it will be worthwhile to take very seriously. These are the sorts of cracks in the global financial system that cascade into very big problems. And though that doesn't mean that this will be the big one that leads to the crisis, it has many of the characteristics that are associated with exactly those sorts of problems. The credit system is very sensitive, and ultimately, the financial system comes down to confidence. And perhaps that will be what determines whether or not this causes the big crisis. It may not be in the raw numbers. It may not be in the businesses themselves. What determines how this ends up could come down to whether investors are just too afraid. Perhaps there are even some investors looking for something to be afraid of, to find some excuse for a sell-off. Most likely media and narratives will play an enormous role in how this pans out, and external conditions could as well shape the outcome. The current situation with respect to Iran and the Strait of Hormuz presents a very troubling backdrop for a credit crisis. Ultimately, the future isn't determined, and it's been my contention that the strong investor thinks in terms of a probability distribution, considering the future as an array of differently weighted outcomes. This might not be what kicks off the next great crisis, but it has many characteristics that are uniquely concerning, and so going forward, this is something worth taking very seriously and keeping a very close eye on.